In 2028, $2 trillion of private credit will hit a wall. The fallout could dwarf 2008, and the part nobody sees coming is the hidden PIK trap. That $2 trillion isn't a distant statistic. It's the money feeding the loans that fund today's tech startups, real estate projects, and even your pension fund. When those loans start defaulting, the losses cascade to the banks that lent the funds, the asset managers that packaged them, and finally to the retail investors who bought the promised AAA tranches. If you own a 401k, an IRA, or even a small brokerage account, you're indirectly exposed. The story you're about to hear isn't a cautionary tale about one rogue CEO. It's a systemic risk that could erode the very foundation of modern finance. So how did we get from a booming credit market to a looming maturity wall that could rip the system apart? ***, the rise of private credit ***. When the pandemic forced central banks to slash rates to near zero, corporations scrambled for cheap money. Traditional banks, constrained by tighter regulations, stepped back. Private credit funds swooped in, offering flexible, unrated loans that promised higher yields. From $500 billion in 2020, the market exploded to over $2 trillion by 2026. That growth outpaced the $2 trillion of subprime mortgages that sparked the 2008 crisis. Investors cheered. Pension funds and insurance companies poured capital into private credit CLOs, believing they were buying diversified, low-risk assets. ***, warning signs ignored ***, but the boom hit a critical flaw. Most of these loans were marked to model, not marked to market. Analysts inside the funds set the prices, and buyers were told to trust those numbers. The IMF now estimates that 40% of private credit borrowers operate with negative free cash flow, up from 25% in 2021. Yet the reported default rate lingered at a modest 1.5%, 2%. Why the discrepancy? Because lenders introduced payment in kinds (PIK). Instead of paying cash interest, borrowers accrued interest into the principal, inflating the debt silently. ***, the turning point. The maturity wall ***, the real danger materialized in late 2025, when the first wave of loans written in 2021-2022 began maturing. Over $500 billion of leveraged private debt is set to refinance in 2028 alone. Interest rates, however, have risen sharply. The Fed canceled its rate cut agenda and signaled further hikes by year-end. Borrowers that once refinanced cheaply now face double-digit rates. With cash flow already negative, many cannot roll the debt forward. ***, but it gets worse. ***, to avoid triggering a technical default, lenders used synthetic PIKs. They paired a missed interest loan with a secondary delayed draw term loan, DDTL, that paid the interest on the first loan. In effect, they were borrowing more to pay the interest on the original loan, exactly how credit card debt spirals. The exposure grew unchecked because synthetic PIKs were not disclosed in regulatory filings. ***, the collapse begins ***, by early 2027, cracks appeared. Stone Ridge disclosed it could meet only 11% of withdrawal requests. Blue Owl froze all redemptions indefinitely. Blackstone scrambled to raise affiliate capital just to keep the lights on. These freezes signaled a liquidity mismatch. The underlying loans mature in 5-7 years, but investors can demand cash quarterly. When defaults rise, asset managers cannot sell the illiquid private loans without slashing prices. The result? Forced fire sales, a plunge in CLO valuations, and a wave of AAA tranches turning toxic. ***, here's what they missed. ***, regulators assumed that the CLO structure insulated investors from individual loan risk, just as mortgage-backed securities had once done. But the opacity of private credit, no public pricing, no transparent disclosures, means the true health of the pool is unknowable. When the first wave of defaults hit in 2028, rating agencies were left scrambling to re-rate assets that were already mispriced. Pension funds that had allocated 10-15% of their fixed income buckets to private credit CLOs saw their risk-adjusted returns evaporate overnight. ***, the aftermath ***, the fallout rippled through the broader financial system. Banks that provided leverage to private credit funds faced write-downs, tightening credit for everyone else. Equity markets reacted to the sudden loss of confidence, and the S&P 500 dipped 12% in a single week. Retail investors who held the safe CLO tranches saw their portfolios shrink, many forced to sell at a loss during a market downturn. Legal battles erupted as investors sued fund managers for misrepresentation. Some fund managers faced criminal investigations for falsifying loan valuations. The crisis, while slower than the flash crash of 2008, stretched over several years, eroding wealth for a generation of retirees. Asterisk, but it gets worse. Asterisk, even as the crisis unfolded, AI hype surged, pouring more speculative capital into tech startups with no tangible assets, just code and GPUs. Those same startups are the borrowers most likely to default, compounding the credit crunch. The combination of a hidden debt avalanche and an overinflated AI bubble creates a perfect storm that could redefine the next recession. So what can we learn from the private credit implosion? Lesson 1, question, model-based valuations. If a price is set by the issuer's internal model rather than an open market, treat it with extreme caution. Lesson 2, watch the maturity profile. A concentration of loans maturing within a short window creates a wall that can crack under higher rates. Lesson 3, diversify beyond opaque credit products. Relying heavily on private credit CLOs is akin to putting all your eggs in a basket you can't see through. The principals didn't set out to cause a crisis. They believed they were innovating. Your advantage is awareness, and that's why you're here. If today's deep dive made you rethink the hidden risks in your portfolio, consider a platform that offers transparent pricing and zero commission trades. Webull's 90-day free trade promotion can give you a low-cost way to test a more open market approach. And if you want more breakdowns of the biggest financial disasters and how to protect yourself, hit subscribe. We drop a new investigative breakdown every week, and you won't want to miss the next one. Criminal or just reckless? Tell me below. Save this video so you don't forget the warning.